In financial markets, activist short sellers operate like a corporate immune system. They hunt for accounting fraud or bloated valuations, place bets against those companies, and then publish their research for the world to see. For years, the absolute pinnacle of this industry was Andrew Left, operating through his firm, Citron Research. Left built his reputation and earned the moniker Bounty Hunter of Wall Street by exposing real-world corporate deceptions, successfully calling out companies like Valiant Pharmaceuticals and Evergrande. That track record gave him immense power. A single tweet or an appearance on cable news could move a company's stock price by double digits in minutes. This high success rate bred complete trust, creating an army of retail investors ready to mirror his trades to make a quick profit. On June 1, 2026, a federal jury in Los Angeles found him guilty on 13 counts of securities fraud. Left now faces a maximum penalty of up to 25 years in federal prison. The man who built a career policing the stock market for deception was actually running a manipulation scheme of his own. The Department of Justice and the SEC proved that Left orchestrated a $21 million fraud. Regulators categorize his method as a short-and-distort scheme, a tactic designed to extract cash directly from retail traders. The setup starts when Left targets a volatile stock already popular with everyday investors, names like Nvidia or Tesla. If we map this out on a timeline, we see that before publishing a single word of commentary, Left secretly bought cheap, short-dated options contracts, financial instruments that let him profit rapidly from sudden price movements. The fraud centered on the direction of these hidden trades. He was positioning his own portfolio to profit when the public followed his upcoming advice and moved the price. Before his followers even heard his voice or read his tweet, the financial trap was already armed. With the hidden trades finalized, Left would then release a sensationalized tweet or appear on television, claiming he planned to hold a specific stock long-term. In one specific instance, he explicitly told his followers that Nvidia was on a fast track to hit $165 per share. Trusting his reputation, retail investors flooded into the market, triggering an immediate artificial surge in the stock's price. This chart illustrates exactly what happened next. Right as the price spiked, Left instantly liquidated his hidden position into the very momentum he just manufactured. He completely sold out of that Nvidia position in under 2 hours, walking away with nearly $1 million in profit. SEC documents later revealed he was even coordinating these announcements with hedge funds, sharing the illicit profits through fake invoices. Left bypassed market research to engineer his own results, orchestrating self-fulfilling prophecies that turned his audience into his victims. Betting against companies and publishing critical research remains legal in the United States. Left crossed the legal boundary because he lied to the public about his own trading intentions. In finance, this creates what is known as exit liquidity, a scenario where a trader uses the wave of buy orders from tricked followers to safely cash out their own position without crashing the price. The evidence was damning. According to the DOJ, Left boasted to associates that manipulating retail investors this way was like taking candy from a baby. This conviction serves as a clear signal from regulators to the entire modern ecosystem of finfluencers and television stock analysts. Federal authorities are now actively scrutinizing the gap between a commentator's public posture and their private trading book. In today's economy, a single public comment can move millions of dollars in a matter of minutes. So the next time a prominent voice loudly tells you to buy or sell a stock, you have to ask yourself, are you receiving valuable financial advice, or are you just their exit strategy?